Now, prior to all this international capital flowing in, we had a system pre-1990 of how John Jones got financed, which is page 13. Pre-1990, we had an entirely different system of financing John Jones of Modesto. We had in place as a financial intermediary this quaint old institution called Savings and Loan Associations, and I don't even know if there are any left. Are there any left in Austin? No, I guess not. About half the banks at that time were known in Austin as savings loan associations, and it was one single intermediary, and so the borrower went to his local S&L, and it was a local business in that the S&L knew these people by name, location. They knew an awful lot about I guess the 3 C's of banking, or was it the 5 C's of banking? 3. Character was one of them. Collateral was one of them, and I can't remember. Capital? Cash flow. Okay. So they knew the collateral. It was local, and they knew the John Joneses, et cetera, et cetera. So they made these loans with the intention of putting them in their portfolio for 30 years. And indeed, that's what they did. And the question is, how did they finance themselves? They received deposits from John Jones's neighbors in the same town. And that's, by the way, it was how we did housing finance in the United States from about 1830 to 1990. And it was a local business. The problem is that machine broke. And the machine broke badly in the in the 1970s and the early 1980s. And I think about the year 1990, the U.S. government put them out of business by putting them into receivership. And you do that because when the market value of the assets become less than the deposits, and you have no capital remaining, then he who grants the charter can take it away. In fact, they're supposed to, except they turn their back for a good decade. The question is, why did those institutions go away? It's not dissimilar to what we're having today, except they went away for a different reason. They went away because the market value of their assets diminished, and as you write assets down, you got to write down capital. That's the only thing I remember about accounting, Jim. If you take something off the left side, you got to take something off the right. and what you take off the right is capital, not deposits, because you owe that to John's neighbors. So the point is, as you start writing these assets off, they don't have no capital, and they don't meet capital requirements. And at some point, the regulator has to, recognize it, and they are committed by law to go in and put the bank into receivership and sell the assets for what they're worth and pay the depositors. And usually by the time the government gets around to it, the market value of the assets are below the deposits. But these deposits are federally insured. So all you people guarantee it. So if there's a loss from liquidation, the bill goes out in your taxes. So you get to pay it. It's a situation where, okay, your deposit gets covered, but then you get the bill for what you just got, for what you just received. You get a check for $10,000 and you get a tax bill for $10,000. So are you ahead or you're not ahead? Obviously, it all nets out to zero. So basically, they didn't want to put Americans in that situation, so they put it off for a long time. They finally ended up facing it, and I think in 1990 raised about $600 billion to pay the shortfall of deposit insurance, but didn't tell anyone. They dressed it up as something else. Now, why, by the way, very quickly, did these assets diminish in value? Because that's where we're going. Because our financial crisis is diminished values of institutions. In that case, it was a different story. The assets diminished in value not because John Jones quit paying the mortgage. In the 1970s and 1980s, in an inflationary environment, you really want to keep your house because the house is appreciating, and it becomes a lot easier to retire the debt because these are fixed interest rate contracts. And basically what happened was that the inflationary environment, which had nothing to do with these S&Ls, created high levels of inflation, which caused interest rates in the markets to rise. And the S&L eventually had to pay higher deposit rates and it became unprofitable because they couldn't do anything with their assets. They bought them over the previous 30 years, and they typically had, like, on an average 5% interest yield. And these deposit rates, once we had freedom, we got rid of the deposit ceilings, these got up to double digit. So you're paying 10% for your money and you're earning 5%, so you're in a losing situation. And if you don't meet the market with deposits, they leave and go somewhere else. And then you got to sell the assets to pay the deposit outflow, and that means that you're going to take a loss, because in an inflationary environment, a fixed income contract is worth less. And so they got boiled down. They across the country. I don't remember. I've written books about S&Ls, but it was so horrendous I frankly couldn't think about it again. It was an industry of about 8,000 S&Ls. I'm sure we're down to fewer than 1,000 today. It was something in that order. And by the way, the government didn't want them around because they thought they were reckless and all that kind of stuff. Who was reckless was the government, creating the inflation. But they thought the S&Ls were the reckless ones. So what they did is they got rid of the industry. They put them to death by basically raising the premium on deposits, the deposit insurance costs that they got to pay for the deposit, way above the bank cost. So whatever remaining S&Ls converted from S&L charters to bank charters. So we basically killed the industry, shot them in the head. All right, now we're back to the sticky problem. You got a foreign saver, foreign bank. The foreign bank wants to hold these assets. John Jones still wants a house, but their S&Ls don't exist anymore. So the question is, how are we going to get the money to John Jones? And what ended up happening at that period of time was some incredible creative finance by Wall Street, investment bankers, and they had a problem to solve, and that's what investment bankers do. Investment bankers, what they do is you find someone who needs money and someone who has money, and you create the link, and you hope that the securities that are issued by the user of the money meets the taste of the buyer. But often it's not the case. And indeed, that was not the case today in this situation. So they had to use some creativeness to satisfy the buyer of financial instruments into the kind of stuff they wanted, which was market-traded, highly rated securities. Now, a mortgage by John Jones is not a highly rated, it's not rated at all, it's not market traded, and it's not a security in the sense of being registered with the SEC. And if the idea of registering with the SEC is you have some protection against fraud. So John Jones couldn't go to the foreign bank and say, how about taking my mortgage so I can build a house? So they had to create these intermediary structures, and that's what investment bankers do, and they did it, and they figured out the formula, and then they started to literally, like a conveyor belt. It was a conveyor belt. It would start on Monday, and by Friday they wanted the securities sold. And here's how they did it. A new industry developed called mortgage bankers who were local, and they went out and originated mortgages, and they had storefront offices across America. And they not only made a mortgage to John Jones, but a lot of his neighbors down to MN. By the way, let's say these are about 700 mortgages. And I'll tell you why in a minute. We get to the number 700, approximately. And the reason the mortgage banker is doing this, he's making money off the origination, usually 1% point up front, and then immediately sells them. And how do they operate, by the way? A loan. And they probably get the loan from a securitizing bank who wants that product, but they don't have offices all over the country. So the securitizing bank wants this raw material product of a package of mortgages for the purposes, essentially, of putting them into a security. And this is going to be the 5-minute lecture in securitization. I'm sure some of you in this audience do this all day long and can come up here and run circles around me of all the nuances of it, but I think 90% of you need the primer, and I do too sometimes. But basically, what they did was the following. They had an awful lot of these mortgages. They were seeking financing, but the buyers didn't want mortgages. What they wanted was AAA securities. So effectively, what the securitizing bank, and by the way, when I say securitizing bank, some of them were foreign, some of them were American, some of them were investment banks, and some of them were commercial banks. And the reason the commercial banks would get into this business is we repealed Glass-Steagall in 1999, and we allowed commercial banks to get into investment banking. But this is an investment banking operation. So it was done by people that we think of as commercial banks like B of A and Wachovia, people that, everyone in that category you've heard about because they've been on the front page of the last 18 months. It included, on the foreign side, it included like Royal Bank of Scotland. It included, for example, Credit Suisse, UBS, also foreign. In America, B of A, Wachovia, Wells Fargo, etc. And don't forget the other guys like Bear Stearns, like Lehman Brothers, and I'm sure that, Merrill Lynch was in it too. So whether you were an iBank or a commercial bank, foreign or domestic, you just simply decided your business model was to buy these raw material debt products that generated income and figure out how to way to package them into what the institutional market wanted, which was high grade, i.e. as rated by the rating agencies, marketable securities. And the way of doing it is called securitization. Basically, they bought those loans from the mortgage bank. Page 11. The mortgage bankers put the pool together. The securitizing bank bought it on Monday. And then they set their staff about to create a new entity called a residential mortgage-backed security. I do have to say, at least I forget, they did this game not only with mortgages, residential mortgages, they did it with commercial mortgages, they did it with business loans, they did it with credit cards, they did it with anything that paid an income stream. And by itself could not be sold as institutional debt. But what they're trying to do is convert any source of income stream, including, it could be, oil and gas income from wells. Anything that's generating income, we got to securitize it and get it rated and get it registered with the SEC and sell it abroad as AAA. And so this is the game of securitizing. Basically, they're creating an end product for what the market wanted. That's what they're doing. Now, in this case, it was really kind of simple. A residential mortgage-backed security were literally sold by the securitizing bank to this entity, which is probably created on Monday. A residential mortgage-backed security is a corporation, in essence. I mean, look, think of it as you all buy mutual funds, I presume, in this room. And what is the mutual fund? Well, it's an entity. And I think that's, Bruce, you might correct me, I think it tends to be a Massachusetts trust company. Basically, the lawyers look for a legal entity that has the least regulation, the least tax, the least reporting, the least hassle from the government, and they don't bother you, and you can do what you want. So it's like, this is really like a mutual fund. Instead of being of stocks, it's of mortgages. And usually when you're buying a mutual fund, you're buying a pro rata share of the entire portfolio. But they then went on and made it a little bit more clever. You could do a pro rata share of the entire portfolio, except that means you just get the average returns of the whole portfolio. So, but what the market out there wanted was not the average of mortgages in the Central Valley of California and the other subprime areas in the United States, but what they wanted was greater security, because after all, the buyer was a very conservative foreign bank. And so the trick became of taking this ball of spin-off of income and spin-off of principal and allocate it to different parties in a different order of priority. They set up an order of priority. Not everyone had a pro rata share of the whole ball, but you'd buy a pro rata share of a piece. And a piece or a slice is called a tranche. I think it's French for slice. And if you buy the first slice, that means you get all the income and principal satisfied to your tranche before any of the tranches below you get paid. So you're the first in line to get paid. And the only way it works and gets to be high quality debt with a bunch of subprime mortgages is if there's, quote, over collateralization. Namely, for example, if the tranche one is like 80% of 100, then you have $100 of assets, and your claim is only the first 80. So as long as the default rate is not, for the whole package, is greater than 20%, you're going to get paid. Now, it turns out that they had to make a lot of estimates of what the default rates would be. And those estimates were something else I could talk about at some length. Basically, the people who made the estimates didn't have my course. That's the best way I can say it.